And right now, bits have gotten going a lot faster, but atoms, which is like customer connectivity, those relationships, people don't like companies and corporations that buy technology products. They don't usually go like, oh, we're going to just jump ship because we've been using, Siebel. We're going to go to Salesforce. It took them a long time. They got there eventually. It doesn't happen. So I believe in investing in those companies where a little bit more at the application layer than the foundational technology layer right now, because their bits are moving so quick. You can't get enough of a period of differentiation over a long enough horizon to really grow and scale in a sustainable way. Versus we have these customer relationships and you found a way to get the customers on board at enough scale, they're harder to dislodge those relationships because you have a lot of other external factors that impact that, in my opinion.
Hey everyone, welcome back to the Ignite podcast. It'll be our last episode for probably a few weeks here. And I'm so excited because I get to talk to my old pal, Marc Ladin. Welcome to the program. He's the partner at Project Voice Capital Partners. I'm so glad you're here, Marc. Thanks for coming on.
Hey, thanks, Brian. I appreciate you having me on.
Well, we'd love to get an intro from you for the audience.
Sure. And my background prior to being a VC was...
You're a VC?
Prior to that, marketing. So as everybody knows, marketing people can be long-winded. So I can go all the way back to my first memories. Or how far back do you like? So let's see. Native Texan, which is funny, in Houston, Texas, grew up and had I came about tech from an entrepreneur's perspective. That my dad was a tech entrepreneur, and he had the idea. He was running funny enough, a tennis club that he bought, and he was really frustrated that he couldn't get any of his books reporting done on a regular basis. This is like the 70s. So he reads some book about, or not some book, some story in like the Wall Street Journal somewhere. It says there's these two companies that come with this new idea called a personal computer. So he thinks that might solve my problem. So he jumps on a plane, he goes, and first company was a bust. Second one was the fruit company down in the valley. And he sat there and said, I want to talk to somebody. And like, we can't talk to you. He goes, I'll just hang on and wait. So he waited for a couple hours, and finally Steve Jobs walks out and says, hey, I'll give you 15 minutes. And he ended up giving him the rest of the day, and they became lifelong friends.
Oh, really?
Wow. PC retail company that became the largest Apple retailer for a period of time.
Wow.
So he was always thinking about innovative ways. So I was early on exposed to some of the interesting industry folks of that ilk, which is fun, right? So some of that rubbed off. So I ended up going to school, got a degree in finance, thought that was the future.
That's why we get along. I didn't know you had a degree in finance. Me too. Yeah, that's so funny.
Yeah, I'll tell you what, it's actually more useful in ways that I never imagined it would be. The quickest side is that, so growing up, my operating days, and I'll tell you about this for just a quick second, a minute, was on the marketing side. It was right around the transition from big brand marketing to more digital media and acquisition, which is more quantitative based. So I'll be the first to tell you that doing like discounted cash flow models and Black-Scholes stuff was really not my cup of tea, but having a nose for how to look at numbers and manage data was pretty helpful on the marketing front as we're making that transition. So it actually became a real big asset. But I went and got a nice good finance, and everybody went into banking. So I went and spent 9 months at Morgan Stanley Real Estate Investment Trust down in Texas. And it was quite honestly one of those boring things I ever did at the time. It was just like a lot of financial forecasting and modeling. And I'm just sleeping through the whole process.
Same. I have the exact same story. Like I got to Wall Street and spent about 9 months, and I was like, this is not going to work out, and washed out, and ended up in marketing like you. That's so funny.
Yeah, it's funny how this the journey goes, but it all roads lead to the end game of some way. So
you're either founding companies or investing in them. If you're a cap, I mean, that's basically it.
You're investing. The asset people always mistake is that the most important investment is your time, right? It's an investment decision. So an operator, you're making a single-threaded investment. As a money manager, you're basically making a multi-threaded investment. That's kind of how I thought about it anyway. So I was at this, opportunity. I was like, man, this is really like I don't know where this is going to go. So I said, let's go do something a little more interesting. And because of some of the tech background opportunities are like, I'm going to work for a computer company in Texas called Compaq Computer, which it isn't around anymore. For those of you who don't know it, it's now HP bought them years ago. And then HP just moved to Texas because they have a giant campus up where I used to work in North Houston, and just for cost and other purposes. Which just tells you where we are on the life cycle of the computer industry. It's very much, when you're moving to Texas, it's not a sign for future growth. That's all I want to say.
Yeah.
So did that 3 years, 4 years in, got some great opportunities, had a lot of fun, learned a lot. I think this is an operator's perspective, but I actually really like lesson and foundational understanding you get from working for a big company, because they've got the process to train you and educate you, and all the things that really help you in the tools you need early in your career to figure stuff out, which if you go straight into startups, you don't always get. So I always looked at as an operator, I'd like for people who work at big companies for a very small amount of time and said, yeah, this is interesting. I learned a lot. Let's go do something for small companies because it's a lot more fun. So for me, I was at when I was there, they had what they called an internet division. I was when they didn't know what to do with a new thing. So they created a division. It's what you do when you're a $10 billion company. And so they created the internet division. I'm working there, and my job was to go out and make partnerships with all of the cool new internet companies that they thought were going to be really interesting, and they could then port their software applications onto Compaq's hardware. So I went and worked with, I think I recruited 23 different startups in my role that I'm telling you, halfway through the process, half of them probably got sold. And I've got going hey, this is kind of interesting. All these guys that I'm working with in these startups are getting sold, and I'm working for this big company. And so I did one of those things you probably are familiar with. It was back of the napkin calculations, like, okay, how long will it take before people really give a shit about what I have to say at this company, right? It was like 6 years. I'm like, 6 years? That's forever, right? I can't do that. So anyway, I jumped ship, went to a startup in the internet access services business. Was a good success. We sold it after 3 years to a public company and learned a lot of great things along the way. A lot about entrepreneurialism, a lot about startups, a lot about valuations, and learned a lot unintentionally about lockups. So we had a 6-month lockup agreement, and where our stock we took was like somewhere between, I don't know, $13, $14 at the deal time. And then when the lockup ended, it was like in a buck or two. So it was one of those like, oh, man. So right when that happened, I was like, okay, interesting, but I still had the bug. So I ended up going and I said, this is interesting. I'm going to stay in tech and do something else. After we sold this company, funny enough, I became an adjunct professor. And I say became one. I was doing that on the side. I said, this is kind of interesting. And they were foolish enough maybe to give me an opportunity at the University of Houston at a Bauer MBA program. They said, hey, we need somebody to talk about the internet and teach on that. I said, oh, a little bit about that, not a lot, but I'll be happy to teach a class. So it was a lot of fun, and I was doing that for a while, and then went to work for another startup. And then in 2005, there was a startup out in California that said, hey, we've got this interesting idea for a new business. We're going to do mass communication during crisis events, and we have this idea around this new technology. It's called ASP, which is the precursor to SaaS, right? What they used to call it, or whatever the new acronym is going to be today. But I was like, yeah, that makes some sense. And so I was like, I made a bet. And so picked up, got married, moved out to California. Company was a good success. It went public, I don't know, 10, 11 years after I joined them. I'd left. I went and did another startup in the mobile space in the communication messaging area. Did that for 4 years. Did one more CNO stint, and then decided that I'd had enough of the single-threaded investment. I said, I'd like working with startups. I don't know what I want to do, but I certainly want to do it for more than one company at a time. So for me, it was a transitional period. It took me about a year to figure it out, Brian. And I'd been in a little bit of angel investing. It's like, I'm really excited about the idea of having a concentrated thesis to orient my thinking around. And I was thinking about the different areas I saw opportunity and potential in. And for me, it became apparent that there's a lot of opportunity in this midpoint intersectionality between interfaces and compute. We're in the age of Alexa. Siri had been around for a while. And so started down that path. I actually recruited one of my CEOs, one of my startups that I'd worked for, had sold the company as went public. And so she and I started to fund one to invest in this space. And it was great. We did that for 2 years. Invested in almost 10 companies. We had a couple of winners coming out of there in terms
not bad. 20% hit rate, not bad.
Yeah, exactly. There you go. Right, the typical numbers, right? Yeah. So I guess I
always go back to numbers. My wife makes fun. She's like, "Are you doing mental math again?" I'm like, "Yeah." I'm just sitting there, doing mental math like all day.
Exactly. That's exactly what it is. It's like, oh yeah, that's right. So it means we're wrong 80% of the time, but I think the 20% works out. So we like that. So and then and
a lot of people know this, that if they're listening to this podcast, but there is an 80-20, and it's almost like a 5-95 law in venture, right? That power law is very, very much prevalent, and you're going to be wrong many more times than you're right. But when you're right, you look like a genius.
Yeah, it's funny. You sent me some notes in advance, like here's some interesting questions to talk about. And it says one of the questions you said is that, what's some of the significant challenges, I think is what you said, in the career as a VC. And, one of the things that's interesting is that you have to get comfortable with the idea that knowing you're going to be wrong 80% of the time is still okay.
Yeah.
Because when you're an operator, it's very different, right? If you're a single-threaded investment, you need to be right 100%.
You know what the hardest conversations are is when you get on the call with the founder and they got 3 months of runway or 2 months or 6 weeks or whatever it is. And they waited too long. They didn't cut their burn fast enough. They're running out of money. And that's like, for me, the toughest conversations. And I'm a small check, so I'm not even the lead. I'm like probably the 5th largest check in the round. And they're like, hey, what do you think about, reinvesting? And I'm like, why are you hitting me up with 6 weeks in runway? You should have had this round done 5 months ago. And by the way, like I told you that 5 months ago,
Yeah,
you should.
It's tough because as an investor, you have a much broader data set than a startup operator does, right? Mm. And so their appreciation for like, oh, I should have done that. I didn't have the experience. Maybe it's my first startup. Yeah. Maybe it's, any number of externalities comes along and they mess up on one of the steps and it can be fatal. And that's the unfortunate part, is knowing that you're investing on a curve that says you're going to have mediocre returns. You invest in 10 companies, 5 you're going to flush. 2 or 3, maybe more, maybe 1 to 2x return of capital, and the 1 or 2 left over make the return. And that is a very difficult adjustment. And even I still find it like scratching my head.
It's really difficult.
How does this work?
Yeah.
Right? It just, the numbers of the exponential returns is very much, it makes up for all the dogs. But that being said, I think that model is probably under duress, especially with public market valuations being much lower. Multiples are coming down. And with AI, the pace of differentiation, the time frame has gotten much smaller. So that I think one of the really interesting challenges we're coming into is that, like, for example, like today investing in a foundational model or a generalized foundation model will be very challenging because it's a hyperscaler bet. But 2, there's no real true moats in that space. Yeah. So what do you do? And so even these guys, when they saw the marketing tools come up with generative AI, the Jaspers and Copy and whatever. Yeah. All those are great for about a blip. And then says that, we can do that too. And it's not that hard.
Yeah. When you're just a wrapper around a large language model, it's hard to compete. But I think, what I am bullish on right now is kind of the vertical SaaS, right? Because I think there's always this, platform shift that happens where a new paradigm comes out and there's all this verticalized, AI that's built on top of it. And you see this with some founders now, right? Where they don't have any margin, right? They're on ChatGPT and, but they're solving a use case and growing super fast. And I know it'll get 10x cheaper next year. And the margins will be there in the long run.
That's exactly the problem, right? Is that that's the thing with these foundational models, the pace and order of magnitudes of improvement each year. It's literally every year. If you look at next year's model compared to this year's model, you're like, can't believe we ever did that. That was like the Stone Ages. The pace of innovation, we're exceeding the Moore's law in terms of how quickly we're able to innovate and grow it and accelerate in terms of our capabilities for these models. And so in the past, you start an enterprise software company or something that was an in-tech company, and you're like, got this unique thing that does X, Y, and Z for salespeople. And maybe you got out there first, maybe it's pretty good, maybe you're Gong, of course, or one of those. You had a differentiation period for a while, for like a year or two. Now it's just that keeps shrinking. So as an investor, that challenge is that, where are you in terms of that growth opportunity and when do you sell? When it's shrinking and the differentiation period is so short, it's a lot more challenging to pick winners because you're a lot more lucky than smart, in my opinion. And it goes back to what you're saying, because it's one of our focal areas around verticalized AI applications. But when you think about this, the saying I like to use is that atoms move slower than bits. And right now, bits have gotten going a lot faster, but atoms, which is like customer connectivity, those relationships, people don't like companies and corporations that buy technology products. They don't usually go like, we're going to just jump ship because we've been using, Siebel. We're going to go to Salesforce. It took them a long time to get up there. Eventually, it doesn't happen. So I believe in investing in those companies where a little bit more at the application layer, that the foundational technology layer right now, because their bits are moving so quick. You can't get enough of a period of differentiation over a long enough horizon to really grow and scale in a sustainable way. Versus we have these customer relationships and you found a way to get customers on board at enough scale, they're harder to dislodge those relationships because you have a lot of other external factors that impact that, in my opinion. And so we definitely have changed some of our focus. One of the things about my investment journey, and I'm still, I think, very new at this and very green, but we were early. Right? We started investing in voice and conversational AI technologies before people really understood NLP and language models and all that stuff. And then suddenly it was like, oh, that's the best thing since sliced bread. And so that appreciation, I think that's nice to see that happen, but it takes a while to figure out, okay, we were right a little bit, but where does that end up in another 5 years? And that's just getting harder to predict, in my opinion.
Yeah.
So there's a lot of things we can talk about there, but it's definitely an interesting and exciting time in the investment fund.
Yeah. So tell us about Fund One. What were those couple wins? Like, what was the thought process? I mean, hindsight's always 20/20, but why only 10 companies? It seems like not a lot of bets. And
sure, I'll give you two examples. And one was intentional, one was luck. So one company invested in was in the hospitality AI space, and there's inbound sourcing and there's outbound hypotheses in venture. So inbound is everybody referrals, or you're this, you're that, and when you're a thesis-driven fund like we are, it's a little easier. People know, like, oh, this is what you guys are doing. I'll know if there's something interesting.
Yeah,
I'll know for you.
Yeah.
Versus generalized can be a little different. The outbound was the opposite. We have different investment theses on what the future is going to look like. At the end of the day, I boiled down VC as fairly simplistically, is that you're basically just looking at lines and trying to predict the end point of the logical conclusion of where they're going. That's all we're doing. We're forecasters, saying like, hey, this is happening now, this is going to happen in the future. And so we got a crystal ball and make some hypotheses. So one of our predictions in hospitality was that we were going to see a lot more interactions using conversational AI within the guest experience in the hospitality world. And so once we had the idea, we said, okay, so let's go vet the idea. And that led us down a process where we looked first at the hotel space. And that turned out to be a terrible space. There's, three parties: the hotel, the investor, the hotel owner, operator, investor, and getting the brand marketer, and getting all those three parties to get alignment in terms of what they actually do or buy or stuff. Like, this nightmare. No one wants to deal with that. They'll be dead before those things sort themselves out. But what came about through that process, we looked at the short-term rental part of the hospitality space and realized that was a lot easier. The purchase cycle and the process for the purchase is way more linear and directed and easier to get to the buyer. And so I ended up canvassing a ton of different companies in the space, everyone I could find, and talking to a bunch of people and getting the data, understanding the lay of the land. And we found a company, found a guy. It was interesting. There was a guy out of Boston, and he'd started this company, and he's like, yeah, we got this conversational AI tool within the hospitality space, and we put it into the short-term rental properties. Like, oh, how far along are you? Well, we've been betaing it for the last 3 or 4 months. We're not charging anything. We think it's kind of interesting. And what we found is that when we do that, we find that on average, they had 7 interactions per guest per stay day. I was like, wait a minute. You're saying when you put these in these short-term rentals, what happens is that the guests will use your service and interface with it per guest. So there's 2 people 14 times a day. Like, yeah, okay. So that was not a hard one in terms of early signal, in terms of product work. Yeah, I was like, okay, that makes sense. Entrepreneur had come from a okay background, very technical, had one successful startup. It wasn't his, but he was on early enough that it was like, okay, he had enough of a nose, had a good mindset, and he had built a product that actually made a lot of sense. So we were the first investor. The return is, I always underrepresent what it is, but let's say it was exponential in terms of return, because we were the first check in.
Oh, nice.
And it just has grown really well.
So you're able to get in at like a 2-4 cap kind of thing very early.
We got in at accelerator pricing.
Oh, so like 1 cap. Yeah.
Exactly. That's how I'm saying. So nonsensical. So what you'll find too, and this has been my experience anyway, is that the larger your check here, right, is not necessarily correlated to your return almost at all.
Well, if you think about it, I mean, the accelerators, it's a different kind of game, right? Like you're you're going to fail 95% of the time, but you're getting in at 1 and 2 caps. So even if they exit at a 5 cap, like that's a 5X, right? That's pretty good. Like if you can consistently hit 5Xs in your fund, you're knocking it out of the park. A 5X fund is like top, 10 or 20%, whatever the number is. So
exactly. That's exactly right. If you do that consistently, that makes a lot of sense. This is exceptional in terms of return, which is great.
Something I wrestle with as I write these like 5 and 10 cap kind of checks, right? And every check I write, I have to believe this can be at 100X, right? I have to believe, okay, I'm the 10 million valuation. It's gotta make it to $1 billion. Can this thing be $100 million revenue company?
Yeah, that's the problem and the challenge for entrepreneurs is that, less than 1% of startups take venture capital. And I think the number is less than 50% even return 1x of the capital. And so the only way that works, that model on the parallel curve is that you're always thinking you could be a unicorn, right? If you don't believe that it has the potential to do that, then it doesn't make up for all the 80% that don't.
Yeah.
And it's tough, right? In terms of how
I had somebody, I had a founder today, I won't name names, but I was like, yeah, what's your vision for where this is in 10 years? He goes, oh, we'll probably exit this in 3 to 5 years. And I was like, man.
Oh, I hate when I hear that.
I was like, I like you so much, but you said the wrong thing. Don't ever say that.
Don't ever say that. Because every time an entrepreneur says, oh, yeah, we're going to flip this thing.
Yeah, this isn't a house. We're not flipping houses here, No. This is a.
It does it that, or even the other thing they do is they'll say, "Oh yeah, we're gonna do a Series A in 6 months." I'm like, "Oh okay, thanks." Just you have no idea when you do your Series A. It just for startups at this stage. So one of the criteria, just clarify for the audience, is that we invest in early stage. First check in all the way up to what we've done Series A just because of deals we invest, just and have long term relationships with founders in the space. We just got it late. We're okay. But generally speaking is that, there's just some signals that you don't have early on. You've got to have some inferences, and that overweighting of the heuristic on founder is more important than ever, which comes to maybe the second one asked about returns. Saying was a company we invested in that was a referral from actually a company. I can't remember if it was I don't think it was in our portfolios. They got this thing is when we passed on. But one of the things I believe as a VC is pay it forward as much as you can. Have a good relationship. Try and be helpful if you can.
Yeah.
I think it's hard at the entrepreneur because
so many times I passed on stuff very early. We're talking friends and family round, maybe pre-seed, but I was nice and I was helpful and I tried to add a little value and I was able to get in at the seed. So like this is such a multi-turn business. This isn't like game theory optimized single turn kind of strategy stuff. This is multi-turn. What is the optimal way of winning this game, which is just add a ton of value to lots of people.
Yeah, exactly. It is so much as reputational.
Yeah.
Because you think about it, this is like a side, but one of the things I always find as a eye opener is that the companies when I was a startup on an operator raised, I think we counted like 160 million capital from different venture folks. So a lot of capital. I will tell you, a lot easier to raise capital, as hard as entrepreneur will say it is. It's a lot easier to raise capital as a startup founder even than it is VC. And the reason
it is
in my experience. Yeah. Is that when you're a startup, you go talk to an investor and you're like, we have this idea. We're going to make a new widget to make serving cheese better. Whatever, right? And they, oh, I get that. That makes sense. I can appreciate that. It seems concrete. Yeah, I think it will. Right? When you're a venture fund, they're like, okay, you're asking me to invest in you. And I don't know what you're going to invest in. You give me some kind of...
Yeah.
But at the end of the day, it's all about you.
Or like, hey, you like to angel invest? I can do it better than you. You should give me your money.
Exactly. That happens so often. I always tell my people, I'm like, look, go and angel invest. I encourage people, if you have the money, you don't mind this, just make sure you're comfortable throw it all away. Because your probability is that the reason we invest in a fund like ours and yours, Brian, is that you're a diversified investment portfolio.
Yeah.
That's it.
Well, yeah, we're doing 150 per fund. So we're looking at over those 3 years, probably 15 to 20,000 investments to invest in 150. So I'm like, if you're willing to put in the work and look at, tens of thousands of investments over the next 3 years and invest in 150 companies, by all means, do it yourself. But if you don't have the time, the wherewithal, you don't like this, then give me your money.
I like it. So looping back in the thread, the second one, which was a total pivot, was that we invested in a company which I thought was a great idea. They were doing basically homegrown sportscasters who could do basically a audio overlay on a sporting event. Effectively, what it means is that, like, so let's say, for an example, you like to watch baseball, and you go on and listen to either your local radio station or maybe it's on TV in your market and where you are, and you don't like the announcer, you don't like the play-by-play or the color guy, whatever. You don't have a choice, right? It's a single-threaded option, right? You don't really have any choice. They created a platform so people, just casual sports commentators, can get on and actually do play-by-play. It's like, oh, that's interesting. So, like, if I'm, for example, female and I don't like the guys that do the play-by-play on baseball games in my market, I want to hear from a female broadcaster. Maybe there's a female broadcaster that's simulcasting your game. Or, even more importantly, think about international. Let's say you're a big NBA fan who lives in China and the feed is all in English. Speak English, and it's like you're missing most of the game. Wouldn't that be great if somebody do play-by-play in your language? So I thought the idea had a lot of merit. And like that actually makes a lot of sense for the future of sports to kind of widen the audience. It's accretive for the sports franchises because they want to have a broader audience. So I'm like, this is kind of a win-win. So they went down that path for a good while. And after, I don't know if it was 12 months after invested, I don't know the exact time frame, they said, look, Mark, we like the business. It's growing in terms of listenership, but we can really haven't figured out a way that monetization is going to work. It's not really doing anything for monetization. So we keep going down this path, but we're going to go rethink what we're doing and do something a little bit different. So I'll give the CEO a lot of credit. He did something that's just a good lesson for entrepreneurs. It's quitting early sometimes is a good thing. I realize about grit and whatever, but at some point you just see like, this idea is not going to work. Right? You know, the next was a magic leap, right? It's not really going to work. It's probably obvious a lot earlier than they figured it out, but it's true. And you just go, you're like, okay, this idea isn't working. So the best entrepreneurs are the ones that do the pivots, right? There's almost none of the successful companies you've been a part of or invested in didn't have some kind of pivot in the journey along the way. And this was a really smart CEO. It goes back to how you qualify and evaluate investments, but he pivoted and he said, hey, we're going to do something different. And what they came up with was they had identified a niche within the sports gambling world that really fit with some of their skill sets. We're going to capitalize this and build a product that caters to this specific issue. And they did that. They took, I don't know, call it 9 months. They did a lot of testing, whatever, and they turned around, launched the product. I think they were at $6 million in ARR in less than 12 months.
Oh, wow.
And just growing like a weed. And so now they have big investors like Sequoia's and the other world. They're all like knocking on the door like, hey, we should invest in you at a valuation that is orders of magnitude for ours, which is really nice. And that was, like I said, that's luck. In some ways, I mean, I guess you say you make your luck, we bet on the...
Yeah, I mean, you kind of bet on the team here a little bit, right? It sounded like you got in really early. They couldn't make it work with the first business model, so they pivot to something else, and all of a sudden it explodes.
Exactly. And so those are exciting because those are like the ones where this is the reinforcement. So there's two mindsets in VCs that I've come across, Brian, anyway. It's either ones where the VC makes a big difference in the start success, or we're just more facilitators and helping it. I'm more the latter camp. I think successful entrepreneurs are going to make a successful entrepreneur. They find a way.
I think that's the dirty little secret of VC is like nobody actually really adds value.
That's like 100% true, I don't think, but the value is this versus...
We had a little value, fundraising help, you know, I mean, the ethos behind Team Ignite was to connect you with any help that you need in the network, and that's true, and I've done that hundreds of times at this point. But, you know, the best founders don't really need my help. You know, they just sort of go execute, and I just get their monthly updates, and I'm like, yeah, they just grew 50% again. Cool. You know, let me know what you need. Can you introduce us to some Series A investors? Because we're ready for that because we have 3 or 4 million of ARR. I'm like, great, I can do that. And maybe that's it. Like some intros to some Series A investors. That's my contribution.
Yep. And you know what though? That's helpful, right? It both all the way around. And so I think that's exactly right. VCs are more helpful at the margin because at the end of the day, people don't really appreciate what a VC is. People, at least outside the world, we're effectively a service business. Right? We're a connector between capital providers and we're employers to capital leaders, which are the startups, right? That's all we do. And so the question is we try and make smart decisions and we try and learn from our decisions, but there is such a high percentage of luck, and it really goes back to the entrepreneur and getting that understanding of like, are they going to be able to manage through whatever the challenges are in the right way? And then there's still a lot of luck, right? So like I said, the last thing I'd say on this, and I'm sure we'll come back to this topic, but these are a little like sheep and trends.
So much so.
It's so like there's all these deals I've seen that are oversubscribed or otherwise. I'm like, that's not a good business. We missed out on, I say missed out, that's not the right term. We passed on investing in what became a unicorn, and it became a unicorn. I don't know if it'll last be a unicorn, because I think the reason we didn't invest was the right decision. But, again, it would have been nice to have that at the bank, but that's not really at the end of the day. You still have to have some heuristic, a conviction. And,
So why did you pass, and what's kind of the learning there?
It kind of came back to the earlier conversation we were having earlier. The product they were building, and I won't get too much of the specifics on this.
Yeah. Keep it general. Yeah.
The reason we passed on it was that, there's two big issues. One, we were actually in between funds, would have been a personal check, which wasn't the biggest issue.
This has happened to me. This is the I ran out of money anti-portfolio.
Yeah. Right. The real reason is when we did the market analysis is that we thought they were super smart. They were pedigreed. They were hungry. I liked them. And that was thing. But the product they were building was a high propensity with all the stuff happening to generative AI to be replicable with very low effort. And, that...
You didn't think there was a moat there?
There's not a moat there.
Yeah.
And again, but I'll tell you what, though, it's kind of like with Slack, right? There are a lot of messaging apps that are out there. They just hustled in terms of their route to market and strategy and how they got little
This is why I like being a high volume investor, is exactly this problem, right? Because if you see the 17th search engine that comes along, and I'm like, who are these guys from Stanford? I already invested in like a search engine, 2 of them actually. Why would I invest in this like 17th search? But if I'm a high volume, if I'm Ron Conway and I'm writing 250 checks a fund or whatever, I'm like, sure, here's 50 grand, 25 grand, that turns into billions of dollars. So and it brings up another thing that I've been wrestling with as an investor too, which is this erosion of moats, right? Now that everybody's empowered by AI, I could go, I'm pretty okay with Python. I can go probably code some stuff up. Now with AI, I'm probably like a pretty decent coder, right? I can go in and I could probably wire up an app pretty quick, just kind of talking to AI, because I know enough about the code, and anything I don't understand, I just be like, explain that, or give me some other ways to do that. And so there's this erosion, I think, happening of it used to be you had to have a big team and millions of dollars to just put up a .com. And now, my 14-year-old can go to Replit and take bounties and make money coding, using ChatGPT, right? And I think there's an erosion of and it comes back to what you said, which is just execution, getting out there and just going after the opportunity and saying, I'm crazy, I'm smart enough to think, to make this happen, but I'm stupid enough to think it'll work, and just going after the opportunity rather than, I don't know if there'll be a moat there, moats become I don't know, almost emergent sometimes from the business. So I've been kind of wrestling with this as an investor, as I look at, we have these 15 things we look at when we make an investment, and I've written articles on it and stuff. And there's really 100 questions that we ask ourselves every time we make an investment. And moat is always one of the hardest ones for me. Is what is the moat here? Sometimes it's really clear. It's a network effect, a system of record. It becomes where the data lives. But, for a lot of these verticalized AI kind of SaaS-y kind of products, there is no moat. Anybody can go to ChatGPT and start wiring this exact same thing up, patents for lawyers or, whatever it is. But I think it's just what's that team that's just going to break down walls? Maybe all that's left is human ambition in the age of AI, right?
That's interesting. I think I have a 10% different perspective. So I wouldn't use the word erosion. I'd use evolution, right? So it's kind of, when you think about modes, I don't think people are more aggressive or less aggressive now than they were in the past. There's probably more attention and awareness of it because we get over communication across social and all these other channels. But think about it this way. Take as a paradigm example. Go back to when the internet came around. Late 90s. And remember, I was like, oh my God, students are start cheating like crazy, right? School's going to be terrible.
Calculators in the 70s, right? Yeah.
Right. Never happened, right? So now ChatGPT comes out, and one of the best experiences I had with it was in November when it became GA. And I had at the time, I guess it would have been an 11-year-old. So what is that? Fourth grade. and he had a assignment and he's struggling on it. It was like compare and contrast the governments of Egypt and Mesopotamia. And so he's like, well, I got the similarity.
Yeah.
I'm really struggling with the difference, Dad. What kind of? I said, here, let me show you something. iPhone, check. He said, look, just ask it, see it says, oh my God. Squealing. I mean, literally squealing. He couldn't believe that was even possible. Right. And so what's happened is that we're in another paradigm shift. I don't know that. I mean, I have this slide. I haven't really finished it, but I've been working on it just because I don't know who started this idea in my head, but I started thinking about it. It was talking about the different economic eras in the last, I don't know, 400 or 500 years. And so the 6 different eras, we're starting with like the 18th century, we had the agrarian and the farming economy. The 19th century is really the first industrialized revolution in our country in production. And then 20th century, we moved into more of the carbon economy. It's like all about energy. So Rockefellers, Standard Oils, that's where all the money
Carnegie
creation.
Yeah. I guess Carnegie was steel, but yeah.
Yeah. And then it went to like the 70s, which was the information age. We had like these mainframes and mini frames and mini computers and personal computers. The last 20 years have kind of been the information economy. It's Google's, Metas of the world and all the attention. And we're at the next inflection, right? We're at the human AI.
Ambient cognition, whatever you want to call it. Yeah.
Exactly. And every time that happens, we have that. There's such a disparate change. And I catch myself all the time. The problem is not that there aren't moats. It's our lack of knowing what they're going to be and our lack of imagination. I think it's fully a failure on our own part. And I'll give you an example. So I was doing someone sent me the data set and it was kind of crap. It was in Excel and it's like poorly formatted, this, that, and the other. And so I said, I don't write macros, but you know what? I'll do simple coding, but not macros. So I'm not basic. But I said, I bet ChatGPT could write that. So I said, hey, ChatGPT, write me a macro that does this, changes that, formats this, looks for this, whatever. And so it takes it, spits it out. Goes, okay, here you go, run the macro. So I ran the macro. Perfect. So that was old mindset. I said, I'm not asking the right question. Yeah. New mindset. Hey, upload the spreadsheet to ChatGPT. Say, ChatGPT, I had to change this, that, and the other. And so it goes through an iterative process of explainable AI and shows me each thing. And at the end of the day, it did the exact same thing. Right. So you think about moats. I mean, Microsoft Excel, like, so why do I need a spreadsheet? Why do I need Excel anymore? And so I just was thinking about that because I'm using an old paradigm. So that's what I see is always happening. So we don't know what it is.
Well, it's kind of like when the car came out, 100, back in the early 20th century, 1905 or whatever. They put the boat rudder steering lever in there. It wasn't a wheel. Mm-hmm. So like people were driving down the road steering a car like they steer a boat. Right. And so, it's that kind of analogy where, we haven't even figured out, we grew up and we adapted, you and I are, roughly the same age and, right, grew up in the 80s. So like kind of in an analog kind of era. And then in the 90s saw kind of the internet come out. But we've, I think we're like the first generation to sort of live through and keep adapting. We're very adaptable because I see people that are, 10 or 20 years older than me. They're really kind of struggling to sort of like use computers in the way that I natively do it. But, I think AI is this democratizing force where now they can just talk to computers and be like, I don't know, I need this. And it just will do it. Like
NLP, baby.
And everybody has an assistant now that is PhD level, the smartest, most whippersnapper MBA type that can go out and just execute tasks for you. And you see some of the demos where they're just watching your screen all day, keeping a record and memory of everything you've done and how you work, and automatically just kind of, I think about this with Team Ignite. Like, will I ever hire people? Like, I don't aspire to have like a 7 billion under management with like hundreds of people reporting to me. It doesn't sound like fun. I had dozens of people at Microsoft. It wasn't fun to manage a large team. It's a lot of work. It's a lot of just managing feelings and coaching and how does it make you feel? And, I'd rather just tell the AI like, hey, I just got 30 inbounds. Here's my framework. Go tell me which, 3 or 4 of these I should actually meet with. And then I would listen to that conversation, listen to the founder pitch, look at all the other stuff I've done in the past. I don't have to go build a fancy doodad, data science, back-tested blah-de-blah to predict. You can just look at all my successes, why they were successful, and look at all of PitchBook, Crunchbase, everything. And then just say, hey, I think as this PhD level person, assistant, this will be really successful, and here's why. And I think in the future, we're all going to just be like these solo entrepreneur corporations of one. You've heard about Sam Altman and his friends betting like when's the first like $1 billion company with like no employees, and what the over under is on that. The over under on that is probably like 7 years. I think that's like the 50-50. It's probably by the end of the decade. And so I'm thinking about this as I start wiring in AI and into my workflows as a fund manager. In the future, probably I won't need to hire anybody. I'll be running $100-200 million funds, which is AI, automation, maybe some contractors.
Yeah, right. I mean, that's the exciting part, right? People always can easily focus on the negatives, can take our jobs away, it's this, that, and the other. That's never what happens. And the freak out is always people can see the jobs are going away now, but they don't know the new jobs there to come. What I think about, and this you brought up earlier, is that now your ability to be an excellent Python coder is like the cost level has dropped so much, it's become a commodity. And so what it does is that it opens it up to an entirely new universe of people, the population on the whole planet, that suddenly can come up with these ideas that you and I in our own backgrounds and biases would never have thought of. And to me, that just means that we're going to have innovation coming on a more global scale, but also in corners and pockets we never thought of, because the cost of entry is much different. I remember, so when the internet came about, building a website seems trivial today. It was like $1 million to $2 million to build a decent website. I mean, people would be like, what? What are you talking about? Nowadays, I mean,
you're wiring up your own server racks and a rented out corner of the data center and all that stuff. Yeah.
Exactly. So George Gilder, who was one of those big technologists in the 90s, wrote this book, and I don't know what it's called, but I'm sure you can look it up. But it was all about like what happens when it was about global crossing connectivity. When suddenly internet connectivity is expensive, you conserve it. When it's cheap, you waste it, which is really good. That's where the innovations come. It's like, remember we used to have, you grew up with the same generation I did around like cell phone bills. It'd be like,
yeah, you had like 200 minutes for this amount, and you had like 300 minutes for that. Remember that?
Like,
isn't that crazy?
Talk quickly, I gotta go. Right?
Yeah.
I mean, that whole
I'm over my minutes. Yeah,
exactly. And so Steve Jobs encapsulated it well when someone asked, was like, think this personal peer thing, we were worried it wasn't going to catch on. Yeah, it's kind of a death thing, Young people get it. The old people just die off, and the young people love it. And that's exactly what's happening. When I was in school back there in college days, I wrote a paper. I don't know what the class is on. It was about the utilization of ATMs. Really boring idea. I basically, correlation and inclusion was exactly what you expected, because like old people want to go to banks into the lobby, and young people want to go to the ATM. And you keep seeing examples of that. For example, you never pay for gas to a person. You don't do that. You put your card down, and eventually you're not going to get out of your car.
Yeah.
Right? We're getting to this point where everything is so self-contained and automated that what we did in the past is going to be so different. And we just don't see it because it's like, the frog in the boiling pot of water. It's totally chipping away at us.
Yeah.
And then you get like people worry about things like AGI and all this other stuff. And, those are realistic questions of the journey, but the journey's going to happen and the innovation will continue. And us as investors, we're always trying to figure out how do we see things that we think are interesting or help people build great products and set solutions to these problems. And that's the fun of it. Moats aren't going away. There will still be moats in the future. We just don't know what they are yet.
Yeah. Well, Mark, this was an amazing conversation. I could talk to you for another hour or two, but I have a hard stop. So I got to wrap up. Thanks so much for coming on the program. We'll have to have you back when you have a big piece of news or just to shoot the shit again for an hour. I'd love that.
Love it. Enjoyed it. And always enjoy catching up with you, Brian.
Thanks, Mark.